All right, Tigers, here we go. I'm going to make sure we get some stuff here in on the Great Recession. It will be helpful for you to watch the podcast, our office hours today at 1:30, because we're going to go through specifically how um, that will go through and help with some of that. So this presentation that we have here will show you how the issues in the housing market caused the crash of the economy. Okay, so there we go. Okay. All right. So what you need to understand is, guys, is that there was this issue called securitization. And I'm going to explain this in a little more detail. But initially what happened was when you would take out a loan early on, um, initially you would take it out from a bank. But what happened was is that the banks started just giving loans out to people and collecting a fee. And so what happened was is that a number of these loans were put together in what's called a CDO, a collateralized debt obligation. So they took hundreds and hundreds and hundreds of loans and put them together. And banks would start buying these loans because you knew you could get money back on a constant return at a constant rate. Okay. And if the loan went bad, then you had insurance on the loan to make sure it would work out. Okay. So what happened was that every time a lender sold a loan, they were paid a fee. So it became good for lenders to try and sell as many loans as possible. Okay, so what happened was normally you need to go through a lot of paperwork to get a loan, but you started to see before the housing crisis, a lot of people jump into these subprime mortgages, meaning you could give a great loan to low income people who couldn't afford the payments on the loans, especially these ones called an adjustable rate mortgage. So for the first couple years, the interest rates would be super low at like 1 to 2%. Okay. But then the rates would then adjust to regular or much higher levels going on and going forward here. Okay. So they thought that the housing prices would still increase, meaning they'd have enough equity in their home, meaning the value of their home, to go through and keep everything sort of running well. Okay. So what happened was here's a bank. They sold a bunch of mortgages to a group we're going to call Fannie Mae. They were an investment group, and then they were paid for it. Fannie Mae took a bunch of those mortgages, put them together, and then they were paid for it. Okay. And what happened is that these people bought these mortgages. Okay. And they decided whether or not to sell them or keep them or this, that, and the other. So for a while, it looked like it was going to work. Lower income people could buy homes they wouldn't regularly be able to afford because they didn't have the down payment. And the investment groups, Fannie Mae and Freddie Mac, financial institutions, profited off these things. Unfortunately, these people couldn't afford the adjustable rates. And it's a ticking time bomb. So what does that mean? Once we got to a point where the housing prices kept going, eventually they're going to fall. And what happened was people started to realize that there wasn't enough money in the housing market. Okay. And so when that occurred, people started selling quickly. And you see a massive sell off is what occurred. And these people that were taking out these subprime mortgages couldn't afford them. So what happened was when the price of their homes fell, they didn't try to restructure the loan, they didn't try to fix the loan, they just left. And so now all of these financial institutions have all of these millions of dollars in loans for homes that no one's paying on. And it's not easy for a bank to sell a house because everybody was out of the market right now. So with less spending, higher employment, okay, December 12th, the Fed creates a term action facility to start lending money to institutions. January, the Fed reduces short-term interest rates, stimulus, all of these things to try and get the economy to get back and going again. Okay. Now what happened was the first market to go was Bear Stearns. Okay, they put billions of dollars into mortgage securities. Okay, Um, and what happened was is that when they ran out of money, the Fed paid Merrill Lynch, that's misspelling of Merrill right there, to like try and keep it out of bankruptcy. And you can see all of these things. Like J.P. Morgan got $2 per share for the bank of for this ING group. Okay, it's just running out of money left and right. So as the crisis started to get worse, oops, I went the wrong way here. Okay, Lehman Brothers, just like Bear Stearns, which was the fourth largest investment banking group, collapsed, and they declared bankruptcy. And everybody was buying money into Lehman Brothers. Okay, so the Federal Reserve allowed Lehman to fail, which is strange because they didn't allow Bear Stearns to fail. Okay, maybe because they had some friends in that market right there. So the other big thing to follow is AIG. AIG is the insurance that would take care of these issues. Like planes won't fly without insurance. So AIG was doing the same thing. And they were pushing these loans on people. And you can see the Federal Reserve had to just jump in and bail out AIG because otherwise the total economy would go. So this brings up the idea of too big to fail, meaning this big $1 billion bailout package that would, no matter what, we were going to save AIG. Okay? Over $8 trillion in bailouts were put out. Okay? And what became very upset with some people is that the people that decided to take their companies in this direction really weren't prosecuted for what they had done. In fact, they received what's called a golden parachute. That's a lot of money to like save them and keep them in play. The economy is going to slide into a major recession, and we're going to need major spending to get us to come out. Okay, so this is interesting. We'll talk about that if it's in detail with it today. So what we're going to do is we're going to go through a little more detail in office hours, how this works and what happened of this. Okay, and then we'll sort of push forward. So you guys have a great rest of the day. Go Tigers.